Are you interested in building real estate wealth without paying taxes? 1031 exchanges are one of the best ways to build wealth doing like-kind exchanges without paying federal income tax. Ron from Rohde Law, and if you subscribe to this channel, you'll really know that I crossed 1,000 subscribers, so I'm super excited, really happy for that. Thank you for everybody that has made that possible. Let's get started. So if you're interested in investing in commercial real estate, smash that like button, subscribe to this channel to learn more about the legal aspect from an investor as well as an attorney in commercial real estate. 1031, what is it, who can use it, and how do you use it to build real estate wealth without paying taxes? And I think the best way to explain it is just to do a very simple example. Along the way, we're going to build through this entire life cycle of, say, an investor that's starting in their 30s all the way until their death. For an investor starting off, let's say that they have $500,000 that they're going to invest in a property. They are a single member LLC. It could be an individual, it could be a partnership, it can be a corp, a trust. Any type of entity is eligible for a like-kind exchange. And in the 1031, which, by the way, it's named for that section of the code. So the IRS code is section 1031, which governs this type of exchange, like-kind exchange. Back to the example. You have your investor. He puts $500,000 down, and let's say he's buying a $2 million industrial property. He has a loan for 75%. He runs the property. He collects cash flow. He manages it well. Over time, let's say over 5-7 years, it increases in value now to $3 million. So he sells, and there's two parts to that. So if he sells for $3 million, he pays off his debt, which now is maybe all the way down to $1 million. And he has $2 million of gain plus his original contribution. What is important to note in that example, basis, which has been depreciated, is lower than the 500,000, and let's say it's 250,000, and the amount that he would owe after the completion of that sale without doing a 1031 would be the $3 million gross sales price minus the mortgage payment, which is, call it $1 million. So he has $2 million, and then that's minus his basis, which even though he initially invested 500,000, for most commercial properties, you're going to take depreciation every year, and that's going to reduce your taxable basis in the property to, let's say, 250,000. So you are looking at a tax bill of $2 million minus 250, 1.75 million as your gain. Now, this is long-term capital gain, so it's going to be taxed at that lower rate depending on your income level. But the point is, it is still a tremendous amount of gain to be paying 15, 20, 25% long-term capital gain tax on. Like-kind exchange allows you to exchange that real property interest, which also applies to other types of businesses. There are some exclusions. It does not cover stocks, bonds, securities, or debt. But for tangible property, for real property, it does qualify. And so if you, identify a replacement property within 45 days, and you can identify multiple properties that you're willing to buy, and then you close on that transaction within 6 months of your transaction being consummated on the sale, that is considered your up-leg transaction. And then you have to complete the down-leg transaction within 6 months, 180 days. These deadlines are very, very strict. There is no forgiveness, and there's no excuses if you're not able to close. So now you take this 1.75, or you have almost $2 million worth of gain. You're able to leverage that into another property, and you could buy, let's say, a $6 million property that generates all of that great cash flow, all of that size, benefits, economies of scale. With your original $500,000 investment, now you can go and buy that tax-free. Let's fast forward, because the essential idea that was my teaser in this thumbnail is you can continue to lever up each time, taking your gain and reinvesting that into a larger, more cash flow from an absolute perspective, bigger and better properties, all the way up until your death. When you die at that ripe old age of 80, maybe 90 years old, and you've got a fantastic portfolio of multiple properties, right? So one thing that I didn't mention is as you're growing this portfolio and now you have $10 million of equity, you can even split that up into 2 different properties with $5 million of equity each. So you have this massive portfolio. You've built all of this equity without paying tax. And at your death, it can transfer to your heirs. And when it transfers to your heirs, they get what's called a step up in basis. So your basis has come all the way down from that original investment. It has been depreciated all the way down to nothing. So if you were to sell this portfolio for 20 or 30 million, say $30 million, your heirs would have a pretty massive tax bill, and you might be forced to sell parts of the portfolio just to pay the tax. However, because of the U.S. tax code, your heirs will have a step up in basis to the fair market value at the time of your death. It's an incredibly powerful tool, and it is basically a gift for the younger generation to say, here's a platform, here's a base that can provide income. You could sell the properties, you could pay for schooling, you could pay for house, whatever, but they won't pay tax after your death. And so that is the easiest way to build an incredible portfolio without paying taxes, and they get a step up in basis so that, people talk about things. I think it's a little bit cheesy to say generational wealth. What does that mean? Well, this is an example, and this is what people think about when they say, very simply, use 1031s to keep levering up to not pay any capital gains taxes, and then you can build all of your portfolio without paying any capital gains tax. Now, let's talk about some of the drawbacks, because there is no such thing as a free lunch. The biggest thing that is constraining these, they're called 1031 buyers, is 2 things in my view. The first is that you have a very strict time period. You have to identify a property. So just because a buyer comes along and wants to buy your property for a good price, you don't necessarily want to sell unless you can simultaneously find another property and want to buy something bigger, something with less debt. And that can be tricky depending on the market. So when it's a very frothy and very optimistic market, when buyers want to buy your property, it is hard for you to necessarily buy, quote, a good deal on the exit. And so that's the number one constraint, is that you create artificial time constraints to maybe push you into a deal that you don't really want to buy. The second is the tax entity structure. So the taxable entity is really what's important. And this happens a lot because there's a lot of confusion between how do you take title to the property, how do you recognize the EINs, and what can transfer over between groups. So there's a couple different tools about this, but the short answer is that your ownership group going in has to stay the same throughout the years. And so it's not a great tool if you are looking to invest as a syndicator, if you are looking for multiple partners, because you don't have the flexibility to capture all of those gains unless you all stick together. Now, there is an exception called tenants in common. That is one way to cobble together different interests so that you are taking a real property interest. You're not purchasing an LLC interest. That is a legal technicality, but is very important, and it makes a huge difference on 1031. So if you buy a property with a tenants in common structure, you're able to partner with other people. You can bring in your 1031 money, and then you can take your 1031 money out because you're still owning a real property interest. It does create some other problems, but tenants in common is one way to solve it. In addition, with the 1031, you also have other options like DSTs, which is a Delaware statutory trust. You have these other funds, you have other UPREIT, you have 721. The point is, there are lots of options once you create this wealth and once you create gain that is eligible for a like-kind exchange. There's a lot of different options for you to pull. And just as a side note, this is a bonus explanation. When you see a lot of these absolute triple net, they may be freestanding retail, they may be industrial or other types of properties, and they're still being traded. Why is a Starbucks, why is a Walgreens being traded for a 5 cap or a 4.5 cap when debt costs are so high? And the short answer is because of 1031 buyers. These 1031 buyers, they prioritize ease, they prioritize simple, And for the most part, their basis is incredibly low. So if we go back to my example, that $500,000 investment, which has now been depreciated down to $250,000, it has scaled all the way up to create $6 million in equity off an original basis of $250,000. They're able to purchase properties, A, for cash, so they're a cash buyer looking to deploy that 1031 money because they need to buy real property to avoid the capital gains tax. But if they're buying it even at a 4 cap, we can do a little bit of the math here. So a 4 cap on a $6 million property generates a pretty low return on $6 million cash. It is a fairly good return if your basis is $250,000 in that $6 million because you're going to basically be getting your full amount of equity every year pulled out in cash. The other caveat for those buyers too is people are competing for that product against financial instruments. So at a time when 30-year T-bills or 10-year T-bills are at 4%, you may be able to buy a Starbucks or a Krispy Kreme for a 5 cap. That is what's attractive. And I think I talk to a lot of investors that say, who's buying these deals? And they laugh at them and they say these are so stupid. You know, I think it's really the wrong comparison. The people that are buying these absolute nets are doing it for the tax benefits, for depreciation, different deductions, but they are taking a little bit more risk versus fixed income products. And they're treating a Starbucks at a 4.5 cap against a bond or against a T-bill that is trading at 3.5 or 3.8. So that's what they're comparing the product to. So that's it for my quick explanation for 1031. There's a whole lot more that goes into it. Contact the law firm if you have questions about structuring the PSA or ensuring that you hit all of your deadlines. We'll drop a link for a few qualified intermediaries, which is the escrow agent that has to hold your funds. The law firm doesn't provide that service, but smash that like button if you found it useful and subscribe for more commercial real estate content.